We did say there have been deals all around, and one of the latest we've had this week has been around Greece. But what has been the reaction in the fixed markets place? We'll be speaking about all of this and more with Alexa Nicolau. She's a fixed income specialist from RMB. Alexa, thanks so much. So let's go back to Greece and the reaction that we had. We've been talking and we've seen the market movements in the equity space, but the bond markets and the currency space, what's been happening there?
We've seen some of the response in the currency space. The bond markets, however, have been very subdued. We've seen a lot of illiquidity. We've also seen, it almost feels like there's more of a wait and see play that's happening in the bond markets at the moment. So on the news that a deal was reached, everything responded quite positively. Obviously, equities all quite positive. The euro strengthened early in the morning, and the rand also strengthened on the back of that initial news. Then, as the day went on and more of the detail unraveled from that, and we realized that actually this has to be accepted by the Greek parliament and other parliaments, then that threw a little bit of a spanner in the works, and we saw some reversal happening in the rand, and we also saw small reversal happening in the bonds. So the certainty of a good outcome is not as high as one might have thought yesterday morning. And so there's still a lot of volatility in the markets, a lot of lack of liquidity. But what has been very interesting to see is, although the bonds haven't moved so significantly, we've seen a lot of bond outflows, so foreign outflows from our bond market this month, and the majority of that on the back of Greece and the uncertainty and the sort of fear of the riskier asset plays at the moment. So that hasn't affected our bonds too much in the price, but we have seen that flow back out of the country.
We talk about Greece a lot, but I think the bigger news on the horizon is going to be the Fed. So what are the implications when the Fed starts raising rates, and what are the different scenarios that are going to probably play through?
Well, what we've always maintained is that for our local market, we are going to be reactionary to the Fed. So as soon as the Fed starts to hike rates, and as soon as we see the global risk-free rate increasing, we are going to be forced to move just to maintain that risk premium priced into our bonds. So we have Yellen speaking tomorrow. We had her speaking last week as well. And what we're looking for is some clarity on when they want to start moving. Obviously, a lot of speculation has been going around this year that it was going to be a September hike coming from the Fed. And the market is starting to price that further out now. So we're looking more at a December hike. But that will definitely have an impact on us. So as soon as they hike, we either have to preempt that and hike just to maintain that risk premium, or we'll have to respond. And we are always constrained by our local domestic factors. So probably better to hike preemptively as opposed to leaving it till too late. But the Fed's definitely one to watch in terms of fixed income.
How much of a factor is Greece and China going to be for the Fed? Do you think that the Fed chair will take these into consideration?
I think she will. I think she'll take them into consideration, but I think that the domestic fundamentals are what she's going to be watching more closely. So she's always going to mention the global risks, China, Greece, emerging markets, and that impact. But I think that they're going to more closely be watching core inflation in America, and they're also going to be watching wage growth and wage inflation. So Yellen seems to be one of the more dovish members of the committee, where she's waiting for a more meaningful pickup in those numbers, whereas the rest seem to feel that it is going to come and it is inevitable. So there is a little bit of that dynamic between the doves and the hawks playing out, but I think they're more closely going to be watching their domestic fundamentals as opposed to the global stuff, but still keeping an eye on any contagion that does come from the global developments.
We talk about the different things. You talk about inflation versus employment here, but if you look at it realistically, inflation is a backward-looking number. You look at inflation is looking at effects that happened quite a while ago. Unemployment is actually a more current-based kind of thing. And if you look at the U.S. unemployment rate, I mean, by any measure, it's either at full employment or so very close to it here. Right. So if you had to look at it objectively, should not the U.S. be probably looking to raise rates sooner rather than later?
Well, I think hand in hand with the unemployment rate comes that average hourly earnings rate. So unless that's picking up, something is going wrong in that market. So either, the survey size is decreasing, people are not participating in that anymore. And I think what's come out over the last 12 months is that a lot of the Fed officials are actually saying, yes, we thought that perfect level of unemployment is 6% for the US economy, but actually they might be able to withstand a much lower unemployment rate without stifling growth. So it does become, although inflation is backward looking, maybe the correct thing to look at is growth, and they want to see that growth pick up before they start to stifle that. And that growth does come hand in hand with the unemployment rate, but also those wages picking up.
Alexa, just finally, what is the biggest risk that is facing South Africa at the moment? You've mentioned that we have seen bond outflows because of Greece. Situation isn't entirely ironed out, but all the factors that we've spoken about, China, Fed, Greece, which is the biggest one here for us?
That's a good question. I would argue that it's China. So there's been a lot of talk, and all the headlines has been about the Chinese equity market. But I think that more of a worry for us is that there's just going to be this cyclical slowdown in growth in China. It's going to be a slow grind, and that is what's going to affect the global economy. So the lower the growth is in China, the lower it is globally, the less demand there is, and that's what we should be watching more than the equity markets per se, because we still don't know what the link is between the equity markets and the real economy in China. So I think China is definitely the biggest risk for us at the moment, but maybe not what's been in the headlines so far, and maybe if we look a little bit deeper.
Alexis, thank you so much. Big thank you to Alexa Nicolau. She was talking to us about the fixed income market, and China seems to be the biggest risk that's facing South Africa currently. Stay with us, because when we come back, we'll talk all things Greece. So a deal has been struck, but what now?